China officially grew at 5% in 2024. Independent researchers at Rhodium Group calculated the real number at 2.5%. Xi Jinping's government has never publicly explained the gap, but it has a specific origin point: August 2020, a policy called the Three Red Lines, 3 debt ratios applied to real estate developers. The policy worked exactly as designed, and that is precisely what broke China's economy. That paradox is where this story starts. To most observers watching China from outside, the economic slowdown reads like a debt story. Too much of it, accumulated over decades of reckless infrastructure spending, finally catching up. That framing is not wrong, but it is incomplete in a way that changes everything. Because the debt was not the system that broke. The debt was a symptom of a system that functioned for 30 years. One regulatory decision made that system mathematically impossible to continue. To understand what actually happened, you have to go back to 1994, not to real estate, to a tax reform. Before 1994, China's fiscal system was decentralized. Local governments collected most tax revenue and controlled most spending. Then, Beijing introduced what it called the tax-sharing reform. The logic was coherent: re-centralize fiscal power, build a unified national budget, standardize the chaotic patchwork of local tax schemes that had developed under partial reforms. What the reform actually did was this. It assigned local governments responsibility for 77% of all public expenditures: education, healthcare, social services, public infrastructure, while reducing their share of tax revenues to 46%, a 31 percentage point structural gap, written into law, never closed. Think about what that means in practice. Every county government in China is operating a mandate it cannot fund from its official tax base. Beijing sends intergovernmental transfers to partially offset the shortfall, but those transfers are inconsistent, politically allocated, and never quite sufficient. Local governments needed another source of revenue. They found one. The mechanism is called a local government financing vehicle, an LGFV. It is technically not a government entity. It is incorporated as a state-owned enterprise under company law. That distinction was the entire point. The 1994 budget law was explicit. Subnational governments could not borrow money without central approval. But a state-owned enterprise operating under company law was not subject to that restriction. It could borrow from banks, issue bonds, take on corporate debt without central review. So here is how the loop worked. Local governments transferred land use rights to an LGFV. The LGFV used that land as collateral to borrow from state banks. It spent the borrowed capital preparing raw land for development, laying roads, connecting utilities, clearing terrain, and then sold that serviced land to private real estate developers at auction. The land sale proceeds came back as revenue, 30 to 60% flowing to local government operations, the remainder servicing the LGFV's debt. For 20 years, this worked. It worked because land prices were rising. When land appreciates reliably each year, the math holds. The LGFV borrows, develops, sells at a profit, repays the debt, passes revenue to the city. Everyone moves to the next project. By 2021, this system was funding 41% of all local government fiscal revenue across China. Not a marginal budget line, the primary mechanism by which Chinese cities paid their bills. In 2021, land auction revenues nationwide reached 8.7 trillion RMB, roughly $1.2 trillion. The LGFV debt sitting underneath that revenue stream, the off-balance sheet obligations that had been accumulating since the mid-1990s, had grown to somewhere between $9 and $14 trillion. The IMF put it at 47% of GDP in 2023. Independent estimates went higher. China has never published the official figure. The number is large enough that publishing it would create problems of its own. Now, This is where Xi Jinping enters the equation.
In August 2020, China's housing regulator summoned the country's 12 largest real estate developers to a meeting in Beijing. The problem was visible to anyone looking. Evergrande alone carried over $300 billion in debt. Developers across the sector had borrowed extraordinary sums to acquire land, build inventory, and expand balance sheets. Officials were watching a speculative spiral and wanted it stopped.
The 3 red lines were the tool. 3 specific debt ratios each major developer had to satisfy. Liabilities could not exceed 70% of assets. Net debt could not exceed equity. Cash reserves had to cover all short-term debt. A developer that breached all 3 was capped at 0 debt growth. No new borrowing, period. The policy was technically well designed. It was meant to force developers to deleverage, sell assets, pay down debt, reduce systemic risk.
It would slow speculation and clean up balance sheets. Rational, measured, standard macroprudential logic. What it did mechanically is precise. Developers constrained by the debt caps stopped bidding at land auctions. They had no capacity for new land purchases. The land auction market, the one generating $1.2 trillion per year, lost its primary buyers in roughly a quarter. Private developers largely withdrew from bidding by 2022. To prevent prices from completely collapsing, LGFVs stepped in as buyers of last resort. By some estimates, LGFVs were purchasing close to 50% of all auctioned land by 2022, up from 17% in 2020. This was not a strategic choice. It was a survival maneuver. And it made the LGFV debt problem significantly worse, because those LGFVs were now buying land at prices the underlying market could not support. Land auction revenue fell from 8.7 trillion RMB in 2021 to 4.15 trillion in 2024, a 52% decline in 3 years. Because 41% of local government fiscal revenue depended on that stream, city budgets across China were effectively cut in half. Residential construction starts, the physical measure of new housing production, fell from 1.2 billion square meters in 2020 to under 400 million in 2025, a 67% contraction. These are not percentages attached to abstract financial columns. These are cranes that stopped moving, workers who stopped being paid. Counties where civil servant salaries went unpaid for months. Infrastructure projects halted mid-construction. The equation that made the system work for 3 decades was simple. Land appreciates, LGFV sells at profit, local government gets funded. The 3 red lines choked developer demand. Demand gone, prices stopped rising. Prices flat or falling, LGFVs were now preparing land at a cost that exceeded what the land could be sold for. The IMF analysis of this dynamic reached a blunt conclusion. Preparing land for development generally costs more than land can be sold for. When that is the operating condition, the loop is not just unprofitable, it is structurally broken. The machine that funded 41% of Chinese local government operations had no path to solvency. But this is where the story stops being a real estate story. Because what the collapse of land finance revenue actually did was trigger 3 separate incentive loops across 3 completely different categories of economic actor, each of which independently produces stagnation, and each of which reinforces the others. The first loop, the municipal official. Chinese local governance operates through what researchers describe as a promotion tournament. The party controls personnel appointments hierarchically. Officials compete for advancement based on measured performance relative to peers. For decades, the primary performance metric was economic growth. Build more infrastructure than your neighboring province, attract more industrial investment, hit higher numbers. That incentive structure drove enormous amounts of investment, often wasteful but productive in aggregate.
Local officials were willing to borrow aggressively through LGFVs because the upside was promotion and the downside could be transferred. The debt would still be there when you left. It became someone else's inheritance. Xi Jinping's anti-corruption campaign changed the tournament structure. Starting around 2016, personal accountability for LGFV debt entered the calculus. Municipal officials now face lifetime personal liability for fiscal crises that develop under their watch. Debt created in 2018 can follow an official into retirement in 2030. The optimal strategy under this new structure is not build as much as possible. The optimal strategy is build nothing that creates new debt. Chinese officials call it Tang Ping, lying flat. Minimum action, minimum exposure. Don't initiate projects that could become future liabilities. The tournament switched from a positive incentive, build, grow, advance, to a negative one, build anything risky, face investigation. When the downside is personal financial ruin and political disgrace, and the upside is a promotion in a system where promotion criteria have shifted anyway, the rational equilibrium is inaction. Private sector fixed asset investment fell to negative 0.1% in 2024. Not zero, negative. Infrastructure that once drove China's most impressive decades of growth was no longer being built. The second loop, the urban household. Chinese middle-class households hold approximately 70% of their wealth in real estate, not in diversified financial instruments, not in equities, in apartments and homes. For 20 years, this was not an irrational allocation. Property was the best-performing asset class in the country. Loading up on it was rational. Then, property values fell 20 to 30% from their 2021 peak. For a family with 70% of its wealth in a single asset class that just declined by a quarter, the balance sheet math changes entirely. The mortgage obligation is unchanged. The apartment is worth substantially less. Net household wealth has collapsed. The rational response is not to spend more. It is to repair the balance sheet, pay down debt, rebuild savings, hold cash, defer consumption until the wealth position stabilizes. This dynamic has a name in economics, a balance sheet recession. Japan experienced a severe version of it in the 1990s. You cannot stimulate out of it with low interest rates alone, because the problem is not the cost of money. The problem is that households are rationally repairing damaged balance sheets, and no interest rate makes that choice irrational. China's version is compounded by structural factors. The social safety net is thin. The population is aging rapidly. Pension systems are under demographic pressure. Alternative financial instruments that might substitute for real estate as a savings vehicle are limited. World Bank researchers observed that households are holding liquid, low-risk deposits even though these offer low real returns, not because they are missing an opportunity, but because the uncertainty calculus makes that the prudent choice. The third loop, the entrepreneur. In 2021, Beijing initiated the most sweeping crackdown on its own private technology sector in its modern history. Alibaba received a $2.8 billion antitrust fine. Ant Group's IPO, positioned to be the largest in history, was halted the night before it was scheduled to list. The private tutoring sector was eliminated overnight by a single regulatory decision. Companies serving core academic subjects could no longer raise capital or operate for profit. Gaming firms received content restrictions. Tech platforms faced data security reviews that functioned as indefinite operational uncertainty. The message to the private sector was not ambiguous, and investors read it accurately. Chinese venture capital firms began divesting from technology portfolios. Those that remained active pivoted away from consumer internet, the high-growth sector that had produced Alibaba, Tencent, Meituan, ByteDance, towards semiconductors and renewable energy. Not because those sectors had superior risk-adjusted returns, because they carried lower expropriation risk. They aligned with stated state priorities. The result is a reallocation of private capital from high productivity, high innovation sectors towards state-sanctioned categories with lower expected upside.
VC firms are rethinking strategies, as one industry analysis put it, because sudden policy changes had already destroyed entire portfolio categories. The rational response is to wait, to withhold, to deploy capital only where the regulatory exposure is tolerable. Innovation in the sectors that drive long-run productivity growth, consumer technology, software platforms, data-intensive services, has stalled. Capital is being redirected, not eliminated, but redirected toward sectors where the state wants investment, rather than where private returns are highest. Those two things are not the same. Now aggregate the three loops. Municipal officials are not investing. Private fixed asset investment is negative. The infrastructure pipeline that underpinned 3 decades of Chinese growth has stalled. Households are not spending. They are running balance sheet repair operations. Consumption, 70% of GDP, is suppressed by rational precautionary behavior. Entrepreneurs are not innovating at the frontier. Capital is being withheld or redirected towards state-aligned sectors with lower productivity returns. GDP equals consumption plus investment plus government spending plus net exports. 3 of those 4 components have structural headwinds operating simultaneously, not because of a bad quarter, not because of external pressure, but because the incentive structure of each actor makes the cautious behavior the only logical choice. This is what Xi Jinping's 3 red lines set in motion, not through intent, not through incompetence in the conventional sense, through a precisely targeted intervention in one part of a system, without accounting for the hidden load-bearing function that part was performing for everything connected to it. There is one metric that makes all of this concrete. Economists use a number called the incremental capital output ratio, the I-core. It measures how many units of investment are required to produce 1 unit of GDP growth. Lower is better. A low I-core means capital is being allocated to high-return activities. A high I-core means you are spending more and more to get less and less. From 1979 to 1996, China's I-core averaged 2.6, one of the most capital-efficient growth runs in modern economic history. An economy deploying capital into foundational infrastructure, roads, power, factories, where the returns on each dollar invested were genuinely high. By 2024, the official I-core had reached 8.5. Using Beijing's own GDP numbers, China now requires 8.5 units of investment to generate 1 unit of growth, 3 times worse than the historical baseline. But the official number uses official GDP figures. Rhodium Group's independent estimates, which put 2024 real growth at around 2.5% rather than 5%, imply an I-core somewhere between 14 and 17. 17 units of investment for 1 unit of GDP growth, compared to 2.6 at peak efficiency. That is not an economy that is slowed down. That is an economy running on a treadmill, pouring capital in, generating almost nothing from it. This is the physical consequence of 2 decades of LGFV-funded infrastructure built to hit growth targets rather than meet economic demand. Bridges in unpopulated mountains, highways through terrain with no industrial base to support them, high-speed rail lines with ridership fractions of projections, each one built on borrowed capital, none generating returns sufficient to service the debt. In Guizhou, China's poorest province, the world's tallest bridge rises 565 meters above a valley floor. It cost $700 million. It connects terrain where GDP per capita is roughly $3,500, 1/3 of the national average. Guizhou's debt-to-GDP ratio is now 137%, more than double the 60% threshold economists identify as a danger zone. The central government is reportedly considering a restructuring package for local government debt that could reach $830
billion. That is larger than the Netherlands' entire annual economic output.
Guizhou is not an outlier. It is the most visible example of a system that operated by the same logic everywhere. Borrow off balance sheet, build infrastructure, fund municipal operations from land sales. Repeat. And then in August 2020, the funding mechanism that made all of it work was severed. Not deliberately, not as part of a calculated restructuring, as an unintended consequence of a rational effort to reduce speculative excess in the housing market. The three red lines policy was a technically sound instrument applied to a correctly diagnosed problem. Real estate developers had borrowed too much. The ratios were designed to force deleveraging. They succeeded. Developers deleveraged. The error was not in the design of the policy. The error was not recognizing that real estate developers were not just a financial sector. They were the buyer of last resort in the land auction market. The land auction market was not just a financial market. It was the primary revenue stream for 41% of all local government fiscal funding. That fiscal funding was not just a budget line. It was the mechanism through which the 31 percentage point gap created by the 1994 tax reform had been quietly bridged for 3 decades. Pull the developer out of the land market, the land price collapses. The LGFV revenue collapses. The local government budget collapses. The official goes from building infrastructure to lying flat. The household goes from spending to saving. The entrepreneur goes from deploying capital to withholding it. Each decision is rational. Together, they produce a locked system. China spent 30 years constructing a growth machine that lifted 800 million people out of poverty, built the world's largest high-speed rail network, and made the question of whether it would overtake the United States feel like arithmetic rather than speculation. That growth machine had a structural dependency no one fully mapped. It ran on a single revenue stream, generated by a single asset class, channeled through a system of off-balance sheet vehicles that the rest of the world barely knew existed. When the man running China decided to clean up one corner of that system, the dependency became visible. By the time it was visible, the cascade had already started. This is not a story about corruption. It is not a story about incompetence in the conventional sense. It is a story about a system with a hidden load-bearing element, and what happens when you remove it without knowing it was there. The window in which China might have consolidated the structural dominance to overtake the United States as the world's primary economic power was always framed as open. The only variable was timing. What the data now suggests is that August 2020 was not just the start of a real estate correction. It was the moment the window began closing. Not dramatically, not with a visible crash, with 3 actors, 3 rational decisions, and a piece of arithmetic that no longer works.